Hello and welcome to Charting Points, a technical look at ag markets. Today is September the 7th, and it's a Thursday. This is our first Charting Points of a Thursday. We're hoping to do these every Tuesday and Thursday now, so it might be a little bit shorter, but hopefully they add some value to you. And when I say they may be shorter, I don't think today's is, but we have a lot to talk about, particularly when it comes to Statistics Canada. First of all, I'm going to put my glasses on because I think it makes me look smarter. All right. First, we're going to get through some disclaimers. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only. It is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the statements or any information contained in the material, and any liability therefore is expressly disclaimed. Past results are not necessarily indicative of future results. All right, let's get into talking about what's coming up here. So tomorrow is Statistics Canada's July 31 principal field crop stocks report. Comes out at 7:30 Central, so nice and early, 6:30 Mountain Time for most of you out there, I think. Just to run through, the average trade estimate for all wheat is 4 million tons. Of that, about 520,000 tons are expected to be durum. 1.7 million tons of canola is expected. We'll talk about that number in a bit. Oats, 1.2, barley, 670,000, lentils, 190,000, and peas, 412. If you want to pause the video at some point and take a look at the low high and what that compares to last year, I'm not going to get into it too much, but those are the numbers that we will be watching for as we go into tomorrow morning. Now, I just wanted to show, this is a screenshot of CGC's data at the end of July 31st. So I just wanted to point out a couple of numbers before we go forward here. I'm going to get my trusty pen out here just to show a couple of things. Number one, durum exports 5.1 million tons. Sorry, that's deliveries. Exports are about 5.1 million tons. So I had the number right. I just circled the wrong number. Canola at 8.1 million. Normally, so just kind of so you're aware, the CGC reports exports, deliveries, terminal receipts, and all that kind of thing from licensed facilities. Now, most of the major commodities, wheat, canola, even durum, are handled by licensed facilities. It's the smaller crops that sometimes are handled by unlicensed facilities. So that would maybe be, some of the special crops like peas or for sure lentils, anything that gets smaller than that. Oats are largely reported by licensed facilities, so on and so forth. So some of the numbers are more trustworthy than others, and some of them are closer to StatsCan numbers than others. Canola, wheat, durum are the three ones that are the most likely to match StatsCan. Oats, barley, or oats are also a pretty good indication, but the others are not as good as indicators, although they may be trending directionally the same. The number is not the same. So I just wanted to kind of bring that up. That's where some of this data is coming from that we're going to talk about here. Before we get into that, though, I'm just going to switch gears here. I'm going to see if I can share my screen here. So as I mentioned, the Statistics Canada, the average trade guess is 1.7 million tons. I do think that that's a little bit rich. I think that based on the numbers that I'm seeing, I don't expect that much. And not that I'm saying that I think the report is going to be super bullish tomorrow, because if I can see the math, I'm sure others can. So I don't know where a lot of folks are getting that 1.7 million ton carryout from, because, first off, we saw some pretty big adjustments in the production side of Statistics Canada recently. So just to kind of lift the kimono here a little bit on some of my dashboards here. So they upped, 2021's production to 14.2. They upped 2022's to 18.7 closely. And then the last reported production was 17.5 for this year. This year will be irrelevant for this chat because we're going to be updating the 2022 S&D in this report. But these two numbers, the production numbers, so I don't think that there's going to be another production adjustment coming from or as a result of the 21-22 crop. I think the reason they upped the production in the last report at the end of August was so that they could help balance the S&D coming into this report. Now, here's where it gets interesting is canola crush last year, 9.875. That is very consistent with what Copa is doing. Copa crushes about 95 or so more percent of the canola that gets crushed in Canada. So most of that is reported. Same thing with exports, right? So I have 8.2 million tons. As you can see, we saw 8.1 million exported out of statistics or out of the CGC. And here is where my ending stocks shake out at when I do the math. And that's at about 1.16 or call it 1.2 million tons. Now, my 2023, I'm still working with the numbers. I'm waiting for this S&D to kind of filter in before I start getting really granular on the 2023 forecast. So that's not necessarily where I think the 2023 is, but this is where the math shakes out on the 2022 ending stocks. And I just wanted to kind of showcase as well where we're coming at from feed waste and dockage. So the one area that Statistics Canada can kind of put or take away numbers from is this residual, which is called feed waste and dockage. Now, last year they had it reported at 898,000 tons of feed use and residual, which means that they basically had to account for the disappearance of, almost 900,000 tons. So that's probably where much of that 1 million tons of extra production is going to go towards on the balance sheet. And as you can see here, I just kind of have some averages, calculations done here. I have 400,000 put in here for 2022 and 2023. So really the only way that my number can go up significantly is if these feed, seed, and residual numbers are adjusted lower. I think the 2021 crop is probably the one that is most susceptible to doing that. So perhaps if they take 500,000 tons out of that number, which would be a pretty big adjustment, and add it to my carryout numbers, we get to 1.7. So maybe that's where the market is looking at, where we get 1.7 million tons of carryout. But if I'm using the math and the numbers that Statistics Canada is giving us right now, the math runs out at 1.2 million tons. So again, if the StatsCan prints that 1.2 million and the feed, seed, and residual for 2021 stays the same, there may not be a bullish response to that because it still is kind of using the same numbers in order to work out the end of the year S&D. Whereas if they do print a 1.7 and they take 500,000 tons out of this feed, seed, and residual from 2021, maybe that is where, it still kind of balances out the same. And you get to the number that the market is looking at. So I don't know. I don't necessarily think that the number printed tomorrow is going to have a massive impact on the canola value going forward. Maybe that's the maybe that's the takeaway here, is that the number could go down to 1.2 if they do the math the way I did it. It could go up to 1.7 if they rejigger some of the FS feed, seed, and residual out of 2021 here. Either way, I don't know if it's going to have a major impact on canola. I mean, there's always going to be volatility during a report day or after a report day, but we've been seeing canola trade a lockstep alongside with the vegetable oil complex. And so it would be odd if it deviated from that in any major way in the next little while. So hopefully that gave you some insight. Again, same thing with kind of the oats, I think was the other one that I had listed here. I'm more in line with on the oats at 1.3. My number here is 1.3. There, the average is 1.2. That's pretty high. It does make sense when you look at the pricing structure that happened as we got into much of last year and the declines in prices that we saw. So, it's not necessarily just, this looks like a massive outlier and it looks like it's too large, but the reduction in prices and even the reduction in prices over and above the losses that we saw in other crops, it does make sense that there would be a carryout this large based on the pricing. So hindsight kind of always gives you that 2020 view. So anyway, that's my number. Those are the two numbers that I think will be interesting as we go into the report tomorrow morning. All right, getting back to the presentation here, I want to talk a little bit about USDA's numbers as well. Now, the corn yield, average trade guess has it pegged at 173.50, so that's a reduction from 175.10. And this report, this USDA report, drops on Tuesday at 11 o'clock Central Time or noon Eastern, 10 o'clock Mountain. So this is a little bit further down the line here, but I think the market is starting to look at this and price this in as these estimates came out, I think, late yesterday afternoon as a whole. Now, there has been, I've had some discussions with folks today just about how these numbers are calculated, and I've seen some other estimates that are actually quite a bit larger, particularly on the soybean yield side. Some analysts will try to will give estimates to Reuters, for example, of what they think that the USDA will print for soybean numbers, which may actually differ from what they believe the actual soybean yield to be. I've seen a couple of big analysts out there who have posted some numbers that are significantly larger than what is expected here, or is even larger than the highest trade estimate here. So maybe over time there is a bias towards larger yields, but for this report, I think there is a pretty big, or at least a pretty big cut to yields expected in beans. Now, the yield in corn is expected to come down as well, but there is some adjustments that are expected in harvested acres as well. I didn't put the harvested acre number on here, but there is some expectation that harvested acres, or maybe even planted acres, will increase in this report as well to kind of help even it out. And you can kind of see here that the last production estimate for the USDA on corn was 15.1, and the new estimate is 15.01. So it's not as big of an adjustment from a production side in the corn as in the beans. As far as U.S. ending stocks, those are expected to move lower as well. So as it shakes out after the 2023 season, the average trade is expecting 207 million tons of soybean carryout. That would be very tight. I think that number may not be factoring as much demand destruction as maybe what the USDA might be showing, or at least that the sales data might be showing. So I think if there is a surprise, it actually might be in how much the USDA cuts some demand, if they are going to do that, or if they're going to wait. This is the September report. I mean, sales coming into this new crop year month have been significantly slower than normal. And I think some sales may have been lost due to the large Brazilian crop or even the low river levels. I don't know if the USDA is going to factor some of those demand losses in this report, or if they're going to wait to see if it evens itself out as time goes on. But I think the risk in this stocks report is more weighted towards what the USDA does on demand than what it does on production. Of course, I do think that there's a potential here for some large surprises on both sides of the coin here. So, I think one should be prepared for some volatility in this report. Looking just quickly at the world grain ending stocks, pretty much some lower numbers across the board here as well as we move through the crop year. Soybean ending stocks globally are expected to drop from 119.4 to 118.6, and corn from 311 to down to about 310. And wheat, an adjustment as well, down from 265 to 264. So I think those are just some token reductions, primarily on the U.S. side of the balance sheet, although the wheat balance sheet may be coming from some increased demand or imports from some areas such as India. All right, I want to talk a little bit about some of the charts that we saw today as well. So here is November canola. We had pretty crappy day in canola. We broke below 2 moving averages in the last couple of days, the 20 and the 50, as well as this trend line that's been in place. We now are watching this 750 support down here. So in my weekly report that I'll release tomorrow, I'll be moving my bias from neutral bullish to neutral bearish. And this would be my bearish target down here to, my neutral bearish target would be down here to 750. So I think it's likely that we will test that area. If that seems unstomachable to you, or you don't want to take that kind of risk, I would consider acting And but you still want to give yourself, I think, some optionality on the upside, or at least some kind of plan B, whether that's a reentry strategy if it starts to rally again, or just even using floor prices here. The cost of floor prices has come down significantly. I'll get into that in a little bit as well. Here's just to kind of illustrate that this isn't necessarily just a canola story. You know, when you look at it during this time of year, your mind probably goes, well, harvest pressure, seasonal lows, all of those things probably come to mind. But I think there's some weakness coming in from other areas of the market that are affecting canola. And a lot of these charts look very, very similar. Here's soybean oil today, also broke the 20 and 50, has almost look at the pattern of these two commodities. And I'm going to go back to canola and just how much of a correlation there is between, right? We saw a rally into July and then a corresponding reduction and then another rally and now this kind of thing here. So, and it's breaking some of the same kind of technical levels, and it has the same kind of, magnet or support level here. If you took all of these prices away, you could almost swap the names of these charts out and they would look almost identical, right? So there's definitely some correlations in the veg oil market to canola, and I think that veg oils are the main driver of the market at this point in time. Also, I think it's important to note that Dalian bean oil is one of the ones that is also seeing some weakness. We saw a bit of a support break today on the 20-day as well. So there might be, if this is going to see some further weakness as well, I think that, there is some worries that the Chinese demand is slowing down at this time as they're worried about some economic issues and they're pulling back on their consumption. And that would include ag commodities as well. And, demand isn't completely elastic, but it isn't solely inelastic either. And even some of the countries that we thought were inelastic prior, such as Japan, have actually showed a surprising amount of elasticity in the demand for canola, particularly in 2021 and even in 2022. We saw some reductions due to the high prices. So there were some demand rationing as well because of price. So it isn't, I wouldn't go out on a blanket statement and say demand for canola into China is inelastic. I think it does have the ability to affect the Chinese slowdown. Definitely has the ability to affect demand of all commodities, not just the majors like metals and energy. All right, I did want to talk a little bit about strategy here. I got a couple here that I just pulled from Reuters option pricing models. So these are kind of ways to calculate some pricing on, and these are particularly floor pricing strategies, a little bit away from the money. So I'm just going to kind of talk through. So our underlying at the time was trading at 783. I'm talking about the November here, although you can also get quotes on some of these types of things for the January, and they aren't that much more expensive. We have seen the volatility move lower recently. It's not cheap per se, but it has moved lower off its highs. And I think that some of these values are very attractive for floor pricing, particularly if you're in the boat where you may feel under hedged or undersold. Maybe there was some concern about your crop. Maybe you're getting into the crop and now you see, okay, I have some more confidence about it, or maybe it's even doing a little bit better than what you thought it might, or a little bit better than your worst case scenario. Whatever the case is, if you feel that you're under hedged in this canola market, here's a couple of options for you that kind of, I think, take care of some of the potential regret for, making a sale. So if you're looking at, kind of cash market or over the counter put option style contracts, this is what a 760 put would have been theoretically priced at today. So this would have been a strike at 760. You pay 2140 plus whatever fees you have to pay for either brokerage or for OTC, et cetera, et cetera. That would essentially give you a futures floor price of about 730, call it 738, fees factored in, and you would have upside. You would leave your futures unpriced, and you would have upside in your futures until the 27th of October. So a couple of months of cushion there. Again, if that's not enough time for you, if you want to be in the market a little bit longer, The January is not pricing that much higher at this point, and I think that that's quite reasonable. 50 cents, roughly about 50 cents a bushel to cover off a significant amount of potential volatility in this market in the next few coming months. Another option would be to use a floor price that incorporates a call style of execution. The call on today, I got quoted on an 800, which is a bit of a resistance level in the marketplace. It is right now costing a premium of about $25 plus fees for brokerage or for OTC or whatever. And so in that case scenario, what you would do is sell your crop cash. You'd even be able to receive the cash and generate some cash flow and get that into your bank account, but still stay in the market. Again, this is expiry of October 27th as well. So here's just, I'm not endorsing these strategies. I'm not recommending these strategies. I'm just kind of illustrating that there is these types of strategies available in the marketplace. I do think at this time that these are very attractive, and particularly if you are looking to just take some action in this marketplace, take some risk off the table, but not have that necessarily that regret looming over the table for you. So just a couple of options. I'd be happy to get on a call with any of yourselves or the advisors if you want to talk through some of these strategies, or even just the theoretical nature of these strategies on how to protect yourself. So hopefully that helps. All right, we're going to get into wheat here. We all got optimistic about wheat yesterday. It kind of pulled back today. It looks a lot more neutral than it did yesterday. I think one of the problems is that, even in our own commentary, we've been talking a lot about the seasonality of wheat and how wheat generally hits some seasonal lows at this time. Well, in the last few days, I've even noticed that this is a pretty common statement to be made in the marketplace. So you're probably not just hearing it from me, although I like to think I'm original. A lot of us are thinking in the same way here. And I think that unfortunately that becomes a problem when everybody is kind of thinking the same thing. And, what's the saying go? When everybody's on the same side of the canoe, that's when it flips over, right? So, unfortunately, if everybody is thinking that we're at seasonal lows in the marketplace and don't want to sell, that means that everybody's probably also has a target in mind as to where they want to make some sales. So rallies in this market may actually be hard to come by, because you'll have to be pretty crafty about where you think the rest of the market is open to adding to their sales. And I'm not just talking about farmers, just anybody who's holding a long position in this market or any of those types of positions as well. So I think that even though we should be at seasonal lows for wheat, I think it will struggle to rally just based on the fact that we don't really have majorly bullish fundamentals at this point in time. And, the other factors in the marketplace, like Russia selling really cheap and all of that kind of stuff, is kind of keeping a lid on it. So although, it may just take longer to get through this seasonal bottom than we would like it to or expect it to, it might get hammered with sales when we do see bumps in price like we did over the last couple of days. Same thing with Kansas, although Kansas is, at the end of today, did keep its nose above the previous support that it breached, but we still did make a new low in the month of September. So if I was to show you a monthly chart, it would still look pretty dangerous. Also, Kansas wheat kind of tried to get over the 20-day moving average today and failed. I don't know if that is also a bearish sign, but I would kind of be more on the neutral side of these markets at this time, until it can kind of prove itself to be more bullish. And I would say we'd want to see a new high in order to get kind of really excited about this market and to kind of show that it's got some legs and is willing to rally out of the doldrums that it is in. So that's around 770, between 770 and 780 is where I would kind of start turning my bias more from neutral or neutral bearish to more of a bullish stance. Same kind of thing with Minneapolis, although, Minneapolis doesn't have that nice, clean previous high. You can say it's here or here. I guess it hasn't lost as much as some of the other markets either. And it actually did trade down back below the support that was broken back here and didn't even come up to test the 20-day moving average. So I guess for all intents and purposes, this chart looks pretty bearish. The only thing really that is bullish is that we do generally see the bottoming of prices during this time of year seasonally, but again, that isn't guaranteed either. So, you want to make sure that you have the coverage that you want coming into the season. It could be a bit of a lengthy bottoming process in some of these wheat markets. Just kind of wanted to show soybeans again ahead of Tuesday's USDA report. We have seen it. We have seen prices come down. It broke this trend line here, although that was a minor trend line. We now have kind of a convergence of support here. We have the 20-day, the 50-day, and kind of a more stronger trend line occurring here. Hasn't broken that yet. If the trend continues that it has over the next couple of days, we might see that break to tomorrow or into tomorrow's trade. There still does look like some vulnerability to sell this off back down into the at least the 1330 area, maybe even this 1300 to 1280 area. So again, this market doesn't even really get monstrously bearish until it breaks down below this 1280. And I'm betting most people don't want to stomach that kind of loss just to find out if it's neutral or it's going to bounce off of there. So if we do start to see a breakdown below some of these support levels, you might want to consider taking some risk off the table. Of course, days before a report, which most people are thinking is going to be pretty bullish, I could see a lot of people not wanting to do that. But so I would always kind of err on the have a plan B if that is what you're going to do. If this market does, or if this report is not as bullish as what a lot of people think it should be, you might be 50 cents lower within a couple of days and not even realize, what's happened. So that would be kind of the canary in the coal mines if it starts to leak below these support levels, before the report. It is going to be difficult though, because if it bounces tomorrow and leaks down below that on Monday, you're not necessarily going to want to make big decisions the day before a report either. So what you want to do is just make sure that you are positioned appropriately for the volatility that may come either way from the report. All right, hope that helps. Thanks for joining us, and we will see you again next week, Tuesday, for Charting Points. Have a great day.